how you can actually pre-qualify yourself for a mortgage. And a lot of people out there just don't really know the process. Now, disclaimer, it's gonna be different for every specific situation. So from a consumer side, we all know that the mortgage application is gonna consist of credit score, your income, and also your monthly obligation. An easy way to think about this is the mortgage company wants to make sure that your income has the ability to repay the mortgage. So a way you can really easily do this is look at your income. An easy example. A couple combined makes $10,000 gross per month, which would be about $120,000 per year. Let's say the new home that you're getting approved for, the mortgage payment is going to be $3,000. So the first thing that the mortgage company is going to look at is your housing expense ratio. And it's very easy. $3,000 divided by 10,000 is 30%. What we look for typically for a housing expense ratio is somewhere around that 30% range. And that way you can know you can comfortably pay the mortgage. Now, the second part comes into what expenses do you have? Those dreaded car payments. Gosh, let's talk about these student loans for a second. A lot of times people will have payments, maybe $500 for a car, $700 for student loans. And then maybe you have a couple credit cards. Someone could have $1,500 in monthly expenses that show up on a credit report. Now, this is what we call your debt to income ratio. So if you have $1,500 in expenses that show up on a credit report, and then you add that to your mortgage payment of $3,000, that would be $4,500. And then $4,500 divided by 10,000 is 45%. And that's your debt to income ratio. Now, typically with great credit, this could be as high as 50%. 45% is gonna be what companies will typically look for. But that just shows that, hey, if I buy this house, if I need to continue to pay my expenses, I'm still keeping 50% of my gross income, which is enough to pay for your everyday fun activities and of course eating and just living.